Welcome back to the Investor Professor podcast. This is Dr. Ryan Peckham, and this is episode 193. On today's episode, July has not been nice to the markets. There's a lot going on. We have the AI trade unwind. We have the re-escalation of the war in Iran, and it has just caused a little bit of havoc and a lot of rotation within the markets. So let's discuss all of these July themes on this episode. So as always, get your mind right and let's get to work. Well, welcome back to the podcast, everybody. Man, July has not been a fun month for the market. There's an old stock market saying that is sell in May and go away. And usually that adage does not actually work out for you. Just kind of one of those stock market lore type sayings. But this year, the sell in May and go away, which would be between Memorial Day and Labor Day, might have actually worked out for you. So it seems like as soon as the clock turned over on the first half of the year and we start July 1st, I mean, the market has just kind of been in this very volatile place. And so let's just talk about some of the themes that we've been seeing here. And that is the fact that, this Iran war is really causing havoc with investors and traders, probably more the traders, the momentum traders, as far as changing strategies are concerned. And so you see where, oil stocks were doing well when the Iran war broke out. And all of a sudden it looked like we were going to have peace and we had some halt in the fighting. And then now all of a sudden, I think the U.S. has bombed them 12 nights in a row. And you get this complete reversal where in July now, I mean, one of the top performing stocks in July has been Chevron. And so you look here, the NASDAQ is down 4.7% just in the month of July. We'll talk about that here in a minute. The S&P is down 1.2%, and the Dow is down about 70 basis points or 0.7%. And so there's just a lot of volatility out there and just cross currents of news where, again, the re-escalation of the Iran war, when most investors thought that was going to be behind us, kind of throws that. And so then you get this rotation where we went from AI stocks and then we rotate into defense stocks and oil stocks. And then it looks like Iran's going to be not going to escalate. And so then that trade gets unwound. And then all of a sudden the AI stocks start working again. And then we re-escalate in Iran. And now all of a sudden the AI stocks have sold off again. And all of a sudden oil and gas stocks are working. And so this is definitely one of those years where if you're trying to trade the headlines, which not something that we ever try to get you to do, it's like you zig, the market zags, and all of a sudden you're in the wrong place at the wrong time. And so you got to be very careful, and you have to pay attention to what are some good companies, like we always talk about. What are the good companies? What should I be using this volatility to help me improve my portfolio? So this is also going to be a big week coming up. We started to have company earnings. Google reported this past week. They scared the market with how much they're going to be spending on artificial intelligence in the data centers. And this week, it's possibly going to be more of the same with Amazon and Meta reporting. You'll notice that one of the stocks that's actually done well in the month of July is Apple. And Apple isn't spending on artificial intelligence. And so it seems like the market is starting to get a little nervous about this AI trade and the fact that these companies are spending so much money. And at some point, why do companies invest in new, technology or whatever, right? Companies are investing because they want a return on that investment. Same as you as an investor. You're investing because You think the company you're investing in is going to do a good job with your money. They're going to invest in something that's going to have a return for them. And so we're starting to hear that drum beat gets a little bit louder, that drum beat of all these companies that are investing. Are they going to get a return on this capital for the amount of money they're spending on artificial intelligence and data centers? Now, when you look, some of these companies, it's not all artificial intelligence. I mean, some of it is cloud. So when you look at Amazon, I mean, they're building out these data centers for Amazon Web Services, providing cloud services to a number of companies. And you'll hear Jassy, the CEO of Amazon, say as soon as they can get it online, they're already selling, they're basically renting it out or whatever they call it. I mean, they've got people who want that space, all the different companies, they want that cloud space. And so, it's just going to be, I think, who are the winners, who are the losers, but that drum beat is going to start getting louder as far as our company's going to be able to see this return. And so that is going to be a theme. You have to look and see, are their margins compressing? Margins is, how much money are they making on the money that they're investing? And because so many of these companies are trying to invest in data centers, you're noticing that the components that go into that are going up. So companies like Micron and SK Hynix, they're charging more for memory. Like all of a sudden, companies, their supply chain, it's like, can they get the products they need to go into this stuff? And supply and demand, if you got all this demand, well, you start charging more. And so all of a sudden, these companies are having to spend more maybe than they thought they were going to spend a year or two ago. And when you look at how much CapEx is out there, capital expenditures versus what they expect, how much the AI build out is supposed to be, I mean, it's a tremendous number. So I think right now, all the big hyperscalers have spent somewhere around, or they've committed to spend around, I don't know, $600 billion. And the expectation is that the AI build out is going to cost $2 trillion. And so all of a sudden, you've heard me say it before, but these are the most profitable firms in the world. And now they are spending through their free cash flow, meaning that, the money they're making, they're spending more than that. They're actually starting to borrow money and commit future capital to this borrowed money. And so all of a sudden you're getting a little nervousness because of that. You're also getting nervousness because as the war with Iran continues to go on and you have oil above 90 again, you have Brent crude at 100, high oil is inflationary. And so all of a sudden we have a Fed meeting this week, which is going to be on Wednesday. It's Kevin Warsh's second meeting. And the market is a little nervous going into this because they don't know, is he going to keep rates steady? Is he going to raise rates? If this inflation continues to increase, at some point, he will be forced to raise interest rates. Now, one reason I think that he might hold rates steady is that the inflation number, when the war with Iran de-escalated and we had that truce for a while, the inflation number did show that inflation was coming down, which is a great sign as far as where inflation lies. And so that might be the one thing that Kevin Warsh could say is, okay, yes, the war with Iran has escalated, but as we saw, if we get some kind of peace or some kind of ceasefire, it shouldn't last. That inflation shouldn't last. So that might be the one thing that he can say to try to prevent that from happening. But there's a lot of companies reporting this week, and a lot of companies that have reported this past week. I mean, they might go up a little bit after hours, and then they get people are selling the news. And so you'll notice that Intel, they were around $100 a share when they reported. They went up to $111. Then they came all the way back down, and the next day they ended up like at $94. And so it looks like a lot of investors, I shouldn't say investors, but traders are using that, some of these moves to maybe get out of some of these positions, or at least maybe not get out totally, but at least, de-risk their portfolio and move it to other areas. So when you look at the stocks that have performed the best in July, I mean, the Dow leaders are Chevron, Travelers Insurance, 3M, and United Healthcare. And so those are some interesting names because last year, 3M, and I mean, the last couple of years, 3M has just done nothing. And obviously, United Healthcare had a really bad year after the CEO was murdered and, kind of all those things. You look at the S&P 500, one of the top performers was PayPal. And that's only because there's a couple companies trying to make a bid to buy out PayPal. So that went up because of that. But you look, it's Phillips 66, Marathon Petroleum, AT&T has been one of the best performers in July, but that's because it was one of the worst performers in June. Man, how quickly things change, right? Everybody, and we talked about it on a couple of the previous episodes, but everybody wanted SpaceX when it was $200 a share. Now SpaceX is like $115, $120. It's come all the way down. And everybody's like, I don't know. It's pretty risky. I don't want that now. It's just investor psychology is fascinating to me. And so if SpaceX was attractive to you 2 months ago when they were talking about it every 3 minutes on TV, now's the opportunity. You're almost getting it at, you are getting it 50% off from its high. And you could basically just start a position. I'm not saying do a full position at all, but I'm just saying, we talked about SpaceX being something for 3 to 5 years out. Maybe now you can at least, buy a couple shares. Tesla was another one that their quarter was not great. They're spending their free cash flow. They're investing in data centers. Tesla's now at a 52-week low. So a couple of weeks ago, it was 408. Now it's down to 311. So, if you've been eyeing some of these companies, you have to, eventually start looking at this bad month and thinking to yourself, maybe I put things on my watch list. I look because seasonality is part of this too. I mean, the volume hasn't been that, great for some of these companies. August, September historically have been, not great months for the stock market. And the other thing that's not helping the technology trade at all is that the South Korean market has changed their leverage, their margin requirements. And so, we should at least, point out that there are all these leveraged ETFs out there. So remember, leverage means borrowing. So if something says leverage, that means you are borrowing money to make the trade. So you will see these 2 times leveraged, 3 times leveraged ETFs that trade like single companies like Micron and SK Hynix and Samsung. This is particularly important about that, the South Korean market. And so you have investors that have margin leverage on their investment account, and then they were using that margin to then trade in a leveraged ETF, almost getting double leverage, triple leverage, quadruple leveraged, all these things, very risky. And it kind of got to the point where it's getting out of hand, and the South Korean government is actually changing the leverage laws in that country. And so all of a sudden, there's a lot of investors that started to get margin calls, some of them that got wiped out completely. And that reverberates through the world because they were, most of those traders, they're traders. Most of those traders are doing a lot of the AI trades. So Micron, SK Hynix, NVIDIA, a lot of those big AI names. And so all of a sudden those things are swinging, 9, 10% a day. Micron up 10%, then down 12%. It is, roller coaster for sure. And so, again, Warren Buffett has always said he's called the stock market a church with a casino attached to it. And sometimes that casino gets a little big. And definitely in some of these AI stocks, the casino is definitely getting a little big. So you look at some of the companies you might own, and, you got to make sure that you're kind of aware of what's happening and make sure you use the right position size where you don't have too much of your portfolio in some of these names, especially if you're doing individual stocks, or partner them with something that's a little bit safe, might be a little bit boring, but that's why I think you're seeing Travelers Insurance do so well. I also think Travelers Insurance is doing well because when you look at the AI trade, you want to invest in companies that are going to be able to use AI to improve their business. So you think of a company like Travelers, well, they're probably going to be able to use AI, implement AI to, process claims faster. They're going to be able to use it to, do paperwork faster. Just all of these things where they can actually improve the operations of the business, and they're not necessarily having to spend all the money to develop these products. And so that's what you got to be careful of, is if the company's going to, spend all this money, there has to be a return somewhere down the road. And going backwards to the part about Kevin Warsh and inflation going, if we have to raise interest rates, remember at the beginning of the year, there was an expectation that interest rates were going to go down. And so now we're flipping that conversation and saying interest rates might go up, which is obviously very hurtful to people in the real estate business. It's going to be hurtful for some of those tech stocks that are very highly valued. And so, it's just very, right now, there's just a lot of things that are out there that you don't have the answers to. You don't know when the Iran war is going to end, if it's going to end. We have midterm elections coming up. We have, companies spending a lot of money on AI, and we have, investors haven't quite seen the return on that yet. And so for some investors, they're like, you know what, I think I'm just going to keep a little dry powder on the sidelines, and I'm going to wait and see till a little bit of this gets a little bit more, less opaque, and I can kind of see some things. So, for many of you that are listening, your dollar cost average investors, you found some good companies, you're adding to those positions, you're saving regularly, you're investing regularly. But this is why we hold some of those companies: Travelers Insurance, Procter & Gamble, Coca-Cola. Like, you have to have some companies that can, prevent the portfolio from moving too much. And so you want to make sure that you're not too exposed, because there is a lot of things that are out there that are just kind of cross currents for this market that, that you really, you got to put them in the too hard bucket. It's going to be really hard to kind of figure out where this goes, and you don't want to zig, have the market zag, and then all of a sudden you're kind of questioning your thought process. So try to get back here to talk about this after the Fed meeting this week. We'll do more kind of in-depth portfolio or podcast in the future about some of these company earnings. But as always, I hope this has been helpful for you. Don't mistake activity for achievement, and I'll see you next time. Thanks, everybody. This podcast contains general information that may not be suitable for everyone. The information contained here should not be construed as personalized investment advice. There is no guarantee that the views and opinions expressed in this podcast will come to pass. Investing in the stock market involves gains and losses that may not be suitable for all investors. Information presented here is subject to change without notice and should not be considered as a solicitation to buy or sell any security. Right Our Equities does not offer legal or tax advice. Please consult the appropriate professional regarding your individual circumstances. Past performance is no guarantee of future results.